Today, we're going to break down ConocoPhillips' latest quarterly report. And really, it's telling two different stories at the same time. You've got one story about booming profits right now, and another about a massive billion-dollar bet on the future. So let's dig in and figure out what it all means.
So here's the whole story in a nutshell. ConocoPhillips is having a fantastic year. They're running their operations really well, and they're rewarding shareholders for it. But all that strong performance is also paying for a huge and, increasingly expensive bet on what's to come. So, how does a company explain a massive cost overrun when everything else seems to be going so right? Let's get into it. Okay, so here's our roadmap. We'll kick things off with what this all means for investors today. Then we'll look at the amazing performance that's driving all the good news. After that, we got to tackle the big project costs, both the good and the bad. We'll get a little preview of their plans for 2026, and then we'll unpack their enormous $7 billion goal. Right, so first up, let's get straight to the point. For anyone holding the stock, in a quarter with a lot of different things going on, management sent one very, very clear signal: they are feeling extremely good about their financial position. And really, there's no better way to show that kind of confidence than this: an 8% dividend hike. That's basically the company putting its money where its mouth is. It's a direct signal that they feel great about their cash flow, not just right now, but for the long haul. As the CEO, Ryan Land, said, this kind of growth is sustainable. It's their way of telling the market, hey, the plan is working. Now, to really get why they're so confident, we need to talk about production. And to do that, you just need to know this one term, BOED. It stands for barrels of oil equivalent per day. It's just the standard way the industry puts oil and natural gas production into a single, easy-to-understand number. Simple as that. And here you go. Almost 2.4 million barrels of oil equivalent every single day. The really important detail here, though, is that this number actually beat their own forecast. That's a huge win on the operations side, and it proves that their assets all around the world are just firing on all cylinders. But that big production number, well, that's only half the story. The other part, which is just as important, is all about efficiency. So it's one thing to produce a whole lot of oil and gas, it's a completely different thing to do it efficiently. And that's exactly what the company pulled off this quarter, getting the most out of their wells while keeping a tight lid on costs. Check this out. The quarter was so good that they actually updated their predictions for the whole year. They raised their production target and they lowered how much they expect to spend. And get this, it's the second time this year they've cut their cost forecast. So the bottom line is they're producing more stuff for less money. I mean, that's the combination you want to see. Okay, so everything sounds great so far, right? Well, it wasn't all sunshine and roses. Now we have to pivot to the company's giant long-term projects. And this is where we see a pretty stark difference in how costs are playing out. Here it is. This is the central conflict of the whole report right here side by side. On the left, you've got the huge Willow oil project in Alaska, where the cost estimate just shot up by over $1 billion. But on the right, their global liquefied natural gas projects, or LNG, actually got cheaper. It just goes to show you the massive challenge of managing these billion-dollar mega projects in completely different parts of the world. So what happened? Why did the cost for Willow go up so much? Well, according to the CFO, Andy O'Brien, it wasn't some kind of screw-up in planning. It was just good old-fashioned inflation. The price of labor, equipment, and construction, especially in a remote place like the North Slope of Alaska, it all just got way more expensive. When you have to bring in specialized workers and gear to one of the toughest environments on Earth, you're going to feel those price hikes more than anyone.
But here's the key thing. Despite all these cost changes, the company made it very clear that the timelines for these super important projects are not changing. The LNG projects are still set to start bringing in cash in 2026 and 2027. And even with the cost issues, they've actually nailed down the timing for Willow to start pumping oil in early 2029. So, keeping all of that in mind, strong performance now but still spending big on future projects, what does next year actually look like? Let's take a look at their early numbers for 2026. All right, first a quick definition. You're going to hear the term CapEx. It just stands for capital expenditures. And all that means is it's the money they plan to spend on the big stuff, the physical hardware, the drilling rigs, the pipelines, all the things they need to run the business and finish those huge projects. And here's the game plan. What's kind of striking is that even while they're pouring money into Willow, their overall CapEx is expected to go down by $500 million next year. Their operating costs are supposed to drop too. And all this is happening while their production stays about the same or even grows a little. That shows some serious capital discipline.
So how does all of this actually turn into cash? Now, don't worry about the specific numbers on this chart. It's just an example to show you the basic flow. A company starts with some money, it makes more from its operations, that's that big green bar, and then it spends it on things like new projects. The whole goal, always, is to make that green bar as massive as possible, which generates something called free cash flow.
And that brings us to the final piece of the puzzle. This is the big, long-term payoff for all this spending and all this discipline. And it all comes down to one single number. And that number is all about free cash flow. This is the holy grail. It's the money that's left over after all the bills are paid and after all the big CapEx projects are funded. This is the pure profit a company can use to pay dividends, buy back its own stock, or invest in even more growth. It really is the ultimate sign of financial health.
And here it is, $7 billion. That's the extra cash ConocoPhillips expects to be generating every single year by 2029. This is a massive, massive target.
Okay, so $7 billion is a mind-boggling number. How in the world do they get there? Well, they've laid out a pretty clear two-step plan. First, from 2026 to 2028, all their cost-cutting plus the new LNG projects coming online will add about $3 billion. Then, in 2029, the Willow project flips from being a place where they spend money to a cash machine, adding another $4 billion, basically all at once.
So, let's wrap this all up. ConocoPhillips had a fantastic quarter from an operations standpoint, beating their own production goals while spending less money. They showed a ton of confidence with that big dividend increase, but at the same time, they're dealing with a tough environment for inflation, which has hit their Willow project hard, even while their LNG projects got cheaper. And all of it, every single piece, is building toward one clear goal, a giant boost in free cash flow by the end of the decade. So what we're seeing here is a high-stakes balancing act. They're delivering profits today while placing these huge bets on the future. On paper, they've laid out a really compelling and disciplined plan. The big question, though, is in a world that's so full of uncertainty, can they stick to that plan and actually deliver the growth they've promised?